So when you hear equity, equity is stocks. So the two ways that a company can raise money is either by saying, listen, you know what, I'm going to give you some ownership in this company. You're going to give me some money. And as a result, now you have some rights to share any profits, right? The other way they can do that is saying, listen, can you give me a loan so that I can expand the business and buy the stuff that I need to buy, and I'll pay you back at a certain time. In the big finance world, the complicated term for that is a bond. A bond is really a contractual agreement to pay back because there's a cost to borrow. So the two traditional types of investment vehicles are stocks and bonds, right? So a stock, as I said, is really ownership in a company. They're raising capital so that they can now go on, do the business and generate profits to pay investors a return. So stocks and bonds. But when you hear stocks, just think of equity. When you hear bonds, just think of a gigantic loan. And same way that you're going to go to the bank to get a loan, it's the same way corporations and governments have to borrow money to do different things. Governments borrow money to build roads, to pay salaries, for infrastructure. It just depends. Now, taking these two traditional types of investments, the stocks or the equity. So let's just say stocks, right? So if you hear stocks, that means equity. And bonds, these two traditional type of investments. An investment company really will pool these investments together in what is known as a mutual fund. So you ask the question of, well, Phil, what's one of the best places to start off for a newbie investor? A newcomer investor, a good place to start off is in a mutual fund. And I can explain why.